In this video, I'm going to solve Willow Limited, and the requirements are to prepare the profit and loss account and other comprehensive income statement and statement of financial position. So here's the question. The formats are ready, and I will pick up the figures from the trial balance line by line and transfer them into the relevant statements. Starting from the top, capital is 50,000, premium is 25,000. So capital 50,000, premium is 25,000. Next, we have revaluation of 10,000, which will become part of my capital. Then land and building is 120,000, and the accumulated depreciation is 22,500. Next is plant and equipment 32,000, accumulated depreciation 18,000. I'm going to underline the main headings so then it's easy to notice the assets, capital and liabilities. Next is receivables 20,280. We have payables of 8,725. Then we have a 5% loan and that is £20,000. There it is, loan figure. Then cash and cash equivalent is 2,113. Next is retained earnings from the previous years, 12,920. And then there is a sales figure of 100,926. There's a purchases of 67,231. Distribution cost of 8,326. And I'll leave the bracket open because there will be addition or subtraction later when we'll go through the notes. Then there is an administration expense of 7,741. Opening inventory 7,280. And then we have dividend paid, which is £3,000, and dividend will be paid out of the retained earnings. So I'm going to write over here retained earnings. Oh yeah, we can subtract straight away less. dividend, and the amount is £3,000. Okay, now all the figures have been picked up from the trial balance. Next, we have to deal with the notes. The first note says that closing inventory is 9420. Also be recorded in the current assets. Then it says that building will be depreciated at 4% using straight line method. Now I'm going to use the red color so that you can see all my adjustments. So the cost of building we need to find out. If you look into your non-current assets, the value of 120,000 is the total of land and building. Remember, land is not depreciated, so we need to find the value of building. And over here it says land is non-depreciable, is included in the trial balance at the value of 40 million. The total value of land and building is 120. Out of that, land cost 40 million. The cost of building is 120,000 minus 40,000, and the value will be 80,000. The depreciation is straight line at 4%, and that will be 3,200. And then there is an information that this depreciation should be charged to administration expense. So in the administration expense, I am going to add 3,200, and in the accumulated depreciation, we will add 3,200. I need to add 2 here because it was erased. Now the total accumulated depreciation is 22,500 plus 3,200. Next, the effect of depreciation of plant and equipment. So let's write plant and equipment. The value of plant and equipment given in the trial balance is 32,000 and the accumulated depreciation is 18,000. And we need to apply 20% because it's a reducing balance method. So we have to take the cost of the plant and equipment, subtract the accumulated depreciation, and then apply 20% on it. Below that, I have been given information that this depreciation on plant and equipment should be distributed among cost of sales, distribution, and administration. In the proportion of 70, 20, and 10. So 70% of 2,800 is 1960, 20% of 2,800 is 560, and 10% of 2,800 is 280. 1960 will be part of the cost of sales. So let's go to cost of sales and add 1960. I will just because I do not have any space here, I can add here depreciation equipment 1960. Well, there was no return outward, so I'm going to erase that so that I have more space. 1960. And in the distribution, we will add 560. In the administration, we will add 280. So the total depreciation of plant and equipment is 2,800, which will also be added in the accumulated depreciation. So 18,000 was from the previous years, we do not know how many years, plus the 2,800 for this year. Next, we have information about the land, that the land has been revalued to 54,000. So the revaluation, there has been a revaluation. So land, $54, take away 40, 14,000, well, 14 million. So this needs to be added in the other comprehensive income. Oh, land, not plant. The 14,000 will be added and be added into the revaluation over here. 14,000. There is already a balance of 10,000 pounds revaluation. We will add 14,000 on top of it. So make sure you tick the figures which you have already dealt with and the notes. Next, third note number 3 says it has been decided to write off a debt of 540, means this customer has gone into bankruptcy, so we will not get this money, and this should be charged to administration expense. So 540, let's add into administration expense. I'll just write over here plus 540. At the same time, we need to subtract it from our receivables because this is the balance which we will not receive. 540. Which is called irrecoverable debt. 540. Next, included within the distribution cost is 2120 relating to the advertising campaign that will run from 1st of January 2001 to 31st of December 2001. You can see in the question that the year end is 30th of June 2001. That means 6 months have passed, Jan to 30th of June, and the remaining 6 months are still falling in the next academic year. That means we have used half of it, and half of that is prepaid. So we'll take 2120 divided by 2 is 1010. 2120. $60. 2120 divided by 2. Now this is prepaid. We need to subtract it from our distribution. And because it's prepaid advertising campaign cost, so we need to include that in our current assets. Next, we have other information which says the loan interest has not yet been accounted for. The loan in this company is 5%. So 5% of 20,000 is 1,000. So we need to include that 1,000 over here as interest. And because we have not paid for it, so we have to record it in our current liability. Interest payable. Next, it says tax is 2700. And remember that we do not pay tax straight away, we pay later after 9 months. So it should be included in our current liability because it's payable. Now let's close the income statement. Opening plus purchases plus the depreciation of equipment minus closing inventory gives us 67051. That is cost of sales. If we subtract it from our sales, gross profit will be 33,875. Total of distribution is 7826. Total of administration expense is 11761. If we add both of them, it is 19,587. If we subtract 19,587 from the gross profit, we will get our profit before interest and tax, and that will be 14,288. If we subtract interest out of it, we'll get 13,288. And when we subtract tax out of it, we will get 10,588, which is profit for the period, and then the other comprehensive income of 14,000, and the total comprehensive income will be 24,588. Now remember that we will not take 245 and make it part of the capital. No, do not do that, because you have already recorded 14,000 in your revaluation. Therefore, profit for the period will become part of the capital, which is 10,588. Next, let's close our statement of financial position. So let's add all our assets and minus the depreciation. By the way, the revaluation of the building, which we have recorded over here, 14,000, should also be added in the land and building. So land was revalued by 14,000. So now we have to add 14,000 plus 120 minus 3,200 minus 22,500 plus 32,000 minus 2,800 minus 18,000 will give us 119,500. Similarly, we are going to add receivables minus irrecoverable debts plus cash plus inventory plus prepaid advertisement, and the total is 32,433. When we add non-current assets and the current assets, the total is 151,933. Next, let's add all our capital. 50,000 plus 25,000 plus 14,000 plus 10,000 plus 12,920 minus 3,000 plus 10,588 will give me 119,508. The non-current liability is only one figure, so I'm going to move it forward. The current liabilities 8725 plus 1000 plus 2700 is 12425. When we add capital plus non-current liabilities plus current liabilities, the answer will be 151,933, and this figure is equals to all the assets. So that's how you solve this question. I hope you found this useful. Thank you.